Canton borrows $10,000 cash from National Bank, 2012. $10,000 cash loan. So, assets, I'm going to call this cash. $10,000 cash. And we also have, now the assets go up by 10,000, and on the right hand side equals liabilities plus equity. And on the right hand side of the balance sheet, liabilities go up as well, so therefore the balance sheet stays in balance. Now we have to look at the income statement. This is not a revenue transaction. This is no expenses involved in net income. And we want to ask ourselves what happened with was this financing, investing, or operations? It's financing. Number 2. Canton invested the borrowed money in securities. So they're going to take $10,000 out of the bank account and go buy securities with it. The liabilities stay the same. They still owe the $10,000. Nothing changes in the equity situation. And again, there is no revenue or expenses involved here. And we want to ask ourselves, was this a financing, investing, or operations? Financing is issuing stock, borrowing money, things like that. Investing is buying securities. So this would be a financing operation. Excuse me, an investing operation. So this is investing. Now, number 3. They earn $600 in investment revenue. So it's going to go up by $600. Cash is going to go up. And net earnings is going to go up again, $600. And I left one thing out. No, I didn't. It's okay. So net retained earnings is going to go up. The difference between common stock and retained earnings, both under the equity section, is going to be retained earnings comes from earning money. Doesn't matter if it's investment income or operations income. It's going to be income. Common stock is earned from issuing common stock. So we want to ask ourselves, is this a revenue or expense item? It's certainly revenue. The money coming in, $600 there. There's no expenses involved. $600 in income. Now, how did the money come in from? Financing, investing, or operations? And it should be for investing. I hope that's what you said, because the money came in from investment purposes. So you'd categorize it on the statement of cash flows as investing. Now, a few people made a minor error here, and I want to address this. Number 4. Accrued interest, that's interest expense on the bank loan of $400. They have to pay back interest. However, they're going to pay it in 2013, but they incurred it in 2012. So they incurred it in 2012. That means they have to put it on their financial statements for 2012, even though they're going to pay it in 2013. So what we do here is we create a transaction. Nothing's going to happen to cash. And what's going to happen here is liability is going to go up, and retained earnings is going to go down. The reason why liabilities goes up, now if you notice, this is on the right hand side of the balance sheet. Just like on the left hand side over here, this was an asset exchange. $10,000 cash for securities. We're giving up $400 in equity, and we're creating a liability of $400 for notes payable. So the balance sheet stays in balance on the right hand side. Now what we do is we go over to the income statement section and we look at $400 for an expense. Why are we going to put it down $400 for an expense and we're not going to pay it until 2013? Is because it's what's known as an accrued expense. And it's an accrued expense, meaning even though we haven't paid it yet, we're acknowledging it's there and we have to pay it. That's why it's an expense now. So cash flow, is it financing, investing, or operations? Hopefully you said none because there's no cash going in or out yet. Remember, the statement of cash flows only pertains to cash going in or out. So the company made $200, and that's the net income over here, $200. Net income, $200, and let's ask ourselves what the cash position was like. Financing, you got $10,000 in. Investing, $10,000 went out. And under investing again, $600 came in. So what is the net change? The net change is $600. Now we're going into 2013. And go through these transactions. First transaction in 2013 is going to be they earned interest revenue of $13.50 in cash. Interest revenue $13.50 cash. So cash is going to go up $13.50. Retained earnings goes up $13.50 to keep the balance sheet in balance. Revenue goes up $13.50. There's no expenses. Now we want to ask ourselves, how is the $13.50 going to be categorized? Financing, investing, or operations? Since it was from investments, it's going to be under investing. They sell the securities $10,000 cash. They sell these securities for $10,000 cash. So that means they have some cash coming in. Number two. So we're going to bring securities down. $10,000 and $10,000 cash is going to go up. Just like earlier, when we bought the securities, it only stays in the left. This transaction stays on the left-hand side of the balance sheet because it's an asset exchange. Now $10,000 came in, and we have to ask ourselves, is it financing, investing, or operations? Well, since he sold an investment, it's going to be investing. Now we're going to look at they accrued $800 of interest on the bank loan. They didn't pay it yet. They accrued $800 of interest on the bank loan. So we're going to go over here and we're going to create a notes payable liability. $800 and negative for $800 for retained earnings. That keeps the right hand side of the balance sheet in balance. And we're going to create an expense, just like we did up here with the $400 when you're paying off the interest. $800. Now again, there's nothing happening at the statement of cash flows yet right here because no cash has gone in or out just yet. We look at transaction number 4. They paid cash for the interest due on the bank loan. There's 2 years worth of interest, $400 and $800. That's $1,200. So cash is going to go down. Cash goes down, and we should have brought the opening balance of the notes payable from 2012 over. This is a permanent account, so that should have come over into 2013. We just carried it over now, and we pay off that as well. We take this down as well, the $1,200. So the balance sheet stays in balance. Notes payable went down, as did cash. Now we have to ask ourselves, was that a financing, investing, or operations activity? Was that financing, investing, or operations? And we're going to find out it was financing, because we're paying off a bank loan, $1,200 cash. Now what we're looking at is that they repaid the $10,000 bank loan. There's still a liability, notes payable. The liability is still up here. This is a permanent account. It still carries over. So by strict definition, it should be in 2013 as well. And now we have to figure out how you're going to pay off the bank loan. So you look at create transaction 5, take $10,000 out of the bank account, and you take down $10,000 out of notes payable. And you have to ask yourself, in the financing section, was that a revenue? First of all, under the income statement section, was that revenue, expense, or net income? It was nothing. There was no revenue or expense associated with it. And you ask yourself, was investing, financing, or operations? It was financing, because that's how you got the money in the first place. Cash went out for financing. And now let's tally this up and see what we have here. So we have revenues. So we have income, $1,350, and expenses, $800. Looks like net income of $550. And we want to ask ourselves now, what the statement of cash flow look like? And the statement of cash flow is going to look like $1,350 came in from investment income, $10,000 came in from the sale of securities, $1,200 went out for financing to pay off interest on the bank loan, and $10,000 cash went out to pay off the initial bank loan, leaving us with $150. And that is how to handle the demonstration problem. I don't have time to do the balance sheet for us because I only have 15 minutes to make these recordings, and then that's all the program allows me. But it's pretty straightforward how to do the balance sheet because we already have it done right here for the most part. Any other questions, please give me a call. I hope this has been of some help. Thank you.